All right, welcome back to another video. In this one, we're going to talk about iron condors. All right, we can essentially profit from the stock price doing nothing. So what is the concept? Well, you're profiting from stagnation. So it's a very neutral strategy. So a lot of traders try to guess, I think the price can go up or down. The iron condor is a trade you can put on that you're essentially betting that the stock will stay neutral or stay within a certain range, okay? And all an iron condor is two credit spreads put together. So you're doing a bull put spread and you're doing a bear call spread. And so when you do that, you build this kind of call wall and this put wall where as long as price stays in between, you're going to make money. So here's kind of a profit tent of what the profit payout would actually look like. So let's say, for example, you short a put. Let's say the stock price right now is at $100 and you put in a credit spread where you're shorting the 90 put and then you're buying the, let's say, 88 put, for example, right? And then let's say you do another one on the call side. So you're selling the 110 strike price, and you're buying the 112 strike price. So you put on two different credit spreads, and what you're doing is that as long as price stays in between, that 112 and that 88 price, you are going to profit. And again, same thing with the credit spread. You're going to have a max profit and a max loss. You know exactly how much you can make or lose in every trade. And because you're getting a credit, right, the broker is essentially paying you to take on this trade. So as long as price stays in between these levels, you can profit. So here's kind of an example on Netflix. Let's say Netflix is coming up, and let's just say there's earnings, and you don't think Netflix is going to make a very big move. So what you do is you put on a iron condor. So you would sell a 470 credit spread. Right now it says just a call, but let's say you sell the 470s up here and you buy the 480s as protection. You do the same thing on the other side. So you would sell the 430s down here and you could buy the 420s as protection, right? And you basically build this kind of wall, and as long as price stays in between 470 and 430 at expiration, you're going to keep that full credit and you're going to profit from this move. And if price goes above it or below it at expiration, you are going to lose money. So here's what you're doing. An iron condor is built of 4 different legs, okay? So let's say price is at $100. You start with the put spread, right? So you're selling the 90 put, let's say for $1.50, and you're buying the 85 put for 50 cents. And then same thing on the call spread. So now you're going to sell a 110 call for $1.50, and you're going to buy the 115 call for 50 cents. You're going to get a net credit of $2, okay? This means the max profit you can make on this specific trade is $2. And so the max loss is going to be $300, right? And so what you're doing is you're taking the wing width, you're subtracting it from your credit times 100. That's how you get $300, right? And so, again, same thing. Your risk reward isn't great. You're risking $300 to make $200, but you're betting on the price essentially doing nothing and staying within a range, right? And you really only need collateral for one side of the trade, not both, because the market can't be at $85 and $115 at the same time. So your risk is only $300. And that's relatively it, right? It's a very neutral type of setup. You're basically just selling two different credit spreads together, and you want to do it when there's high IV to make a lot of money. But you can do these on 0 DTEs every single day to make money. As long as the market is essentially doing nothing and staying within this range, you can make a lot of money. So it's a very, very popular strategy. A lot of traders like to do this every single week, every single month on different stocks, because a lot of times markets just go up and down and they stay flat, and this is the best way to take advantage of that. So hope you guys did enjoy this short video, and I'll see you in the next one.